This is a video about making a financial model for an airport. So here's our airport. We're financing a little construction of a terminal at the airport. Here's where it's finished. This is not a large airport. Here's the runway that had to be repaired. Now, when in making this video, I'm really making it because I'm practicing for a little class I'm going to teach, and they asked me to do a little study on an airport, and they gave me a financial model. So part of this video is to show you what not to do in financial models. We're going to look at a financial model and what not to do. Now, I don't have any rules. I have some rules. That's not true. I don't. No, I didn't want this one. I don't have a whole lot of rules because I think foolish consistency is a hobgoblin of little minds. I can't even say that. Adored by consistency, adored by little statesmen and philosophers and divines. With consistency, a great soul has simply nothing to do. He may as well concern himself with his shadow on the wall. Okay, and that was a pretty interesting quote, but I'm going to be inconsistent with some of the things I've said. There are some rules. There are some rules when we go through our model. We're going to see this. Now, at the end of the day, I haven't even done this. We're going to compare this airport to Heathrow and Gatwick and everything else, which had a peak and a trough, and what these rating agencies seem to do is when you evaluate your models, you go from this peak to trough, and we want to see if it can withstand a downside kind of case of passenger traffic. I don't know if this is even passenger traffic. Yes, it must. Pax, I assume, is passengers. Well, it is. Okay, and then so we're also going to go through some pretty important cash flow waterfall items. Now, they had a collection account coverage ratio. What they were able to do is take the number of passengers, multiply them by the price per passenger that they collect, and compare that to the debt service. And then they have a little criteria. Now that assumes it kind of drove me crazy a little bit because it assumes that you pay the debt service before you pay operating expenses. So what are you going to do? If you can't meet the debt service or the operating expenses, are you going to say, tough, you can't pay your employees, you can't pay the people to whatever, open the airport, check the baggage, you're going to close down the airport because you don't have enough money for this account? I think these waterfall issues are very tricky. And that's really one of the key ideas of making this video. Now, we'll also compute a few other ratios. We'll compute some DSCRs, but we'll use a synthetic DSCR, LLCR, and absolutely also a debt to EBITDA ratio. Okay, now, why don't I introduce the original model first? And this is, a lot of this video is going to be about fixing this original model. Okay, and I opened it up and I was supposed to look at it for my class, and the first part was very impressive, beautifully laid out. Look at the artistic layout of this. Okay, disclaimer. And then they had a historical financial statement. Now, this is a key point. Is an airport project finance or corporate finance? It's got non-recourse debt. The debt might be amortizing debt. Seems like project finance. It's one big project. But then you've got a whole lot of history. And if you don't start with history, you're an idiot. That's in anything in your life. I've said that again and again and again. So we have that certainly doesn't look like project finance, and we don't have a defined end date. So that's kind of not project finance. And hmm, I'd say it's probably a little more like corporate finance than project finance, especially from a modeling standpoint. And we have to start with history. And they had some actual financials, and then they had some data for March. So this was, I guess, an actual, and they had some data for March of the next year. It's a little bit out of date, but who cares? You can change the dates. This is an example. But then for the balance sheet, they had no forecasted balance sheet. And then over here, they have a budget for the next year. And how do we incorporate all of this budget and actual with some balance sheets, not balance sheets? So I talk about corporate models and the historic switch and the magic of the historic switch a lot, but how do we actually do this? And then let me show you some other. Then I put this one in, and this looked pretty good. Oh, look, they have nice, beautiful kind of layout of the assumptions. Why do they suddenly have a scenario analysis in the middle of a sheet? Well, that looks a little fishy. And then you start looking at the output, and they have oh, this isn't so bad. They have some budget, and then, oops, oh, it changes in the middle. That is a crime. That is a crime. And you can go to the website and see my discussion of modeling crimes that I probably should update. I put this in the A to Z there. Eight. Shoot. Come on. Oh, I can't seem to do this. A to Z timeline, and I put a little person in jail, and I said, here's what not to do. Certainly what not to do is pretty obvious. Okay, so, and they have some other things not to do. Certainly another thing not to do is to not have any history next to the forecast. That's really, if you want to make a forecast, you want to see, if you have some historic data, that's a fundamental principle of, I think, of corporate finance. You put the history next to the forecast. Here's some other changes. They even have it, I think, in some different colors down here. Here's a change. Here's a formula. Here's a different formula. Then we go to that formula. How it's so obvious not to do that. I don't even have to talk about it. And then the real issue is, do you take the revenues and then pay the tranche A, then pay the OPEX? So what? You're going to pay off the debt and tell all the workers, I already said this, they can't get paid. And then you see how much cash you have left, and then you have this waterfall. And this is the only, basically, this little minimum formula, I think, is about the only formula they had in the waterfall. That does seem to be a consistent formula. They put yes, no. Of course, we need a switch for this. And there's some payment in kind debt. So the waterfall issues are a little bit complicated. This is interesting. Okay, the EBITDA is way down here. Of course, EBITDA should be just about at the beginning. There's some inconsistency here, and then this is horrible when you put some things in columns and some things in row. Come on, everybody knows that. There's a little bit better of a layout, but in a cash flow waterfall, you want to see what defaults, where the defaults occur under this downside case with this peak to trough garbage. And then we've got some debt to EBITDA, which should be going down, and you can compare that to the covenant. Okay, so let's see how to fix this. Okay, and the way I'd say to fix this is, number one, I have some notes here. I'm going to go through some real use of switches. I'm going to say making a good date analysis is so crucial. It's more and more obvious to me the older I get, and shouldn't be doing this stuff anymore. Now we're going to make an annual model from a periodic model, but you start with a periodic one and you don't go backwards ever. You need to start with the finer periods, and then we can use different budget things. And I said, don't pollute the existing financials with forecast. Keep the existing financials separate. Okay, and then we're going to link the history. I'm just reading this stuff. Okay, throw all the key kind of assumptions on a scenario page. The model might be a little bit slow with some sum ifs, and we'll talk about that. We'll talk about some refinancing and defaults and a cash flow waterfall. So here's how I structured the model just a little bit differently. We have some historic and some budget, just like I showed you. Okay, and then for all the switches or flags, I put, here, why don't I do this? I'm just going to show you a little generic macros on the way. Most of the world doesn't like true and falses, so I'm going to multiply these by 1. Okay. Oops, that one I can do myself. And I'm trying to do just a little bit of Excel for you here. Okay. All right. Good enough. And then what I did, Hetty she demanded this. Oh, she said, oh no, you've got to shift control squiggle. That's what I'm doing now. Okay, and if we want to do this, shift control R because generic macros are open, and then control alt C. What I have now in the generic macros is, first of all, another column for the sums. Big deal. Include conditional formatting. Now it says true or 1, false or 0. It says tab color now. This has been fixed. And when we do the tab color, we can always start. The default is just if there's a 1 and a 0, make it. Let's make it a little bit brighter here. Okay, so you run this was, remember, Control Alt C, and then it's going through everything now. If you have a large sheet, by the way, this is the thing that's the hardest. When we do that, we start with just what's our historic. Maybe this is kind of nicer. Maybe you can even see it a little better than true false. Maybe Hetty's right. And then the forecast switch, which should be, it should be equal not, oh shoot, well, I'm going to leave it for now. This should be, this is just if it's not the budget, excuse me. This is if it's after the budget, a pure forecast, excuse me. So I use some ands, and if not complicated, to figure out what timing is the budget and when's the forecast. These are inputs, and we, instead of just one single historic switch, we have multiples. Now you start with the historic financials. Don't pollute this with forecasts. Here's the forecasted balance sheet, and then we start with our forecast. Now it seems that I had a oh, this is because of the 1s and 0s. Oh no. Well, whatever. I'll do the generic macros again. I should have started it later, and I should check that. Okay, whatever. I'm just talking to myself. Now, this is if it's not the historic switch, then we take we take a lookup. If it is the historic switch, we just take the actual traffic. And then we have to divide it by 2 because people go in and out and all that stuff. Disembarking and embarking passengers and all that. But the key is, another key is if it was the historic period, sometimes we have 12 months in a period, sometimes we have 3, sometimes we have 1 month. That's the historic doing this. So this was just an input. And we have different periodicity, and don't let that mess you up, because we can put the annual amount in, and then we basically take that and adjust it for a seasonal factor and get month by month data. Okay, enough of that. And then Oh, this is again the ones and zeros. Excuse me. I have to fix that one because oh, well, I have to change the column. I'm talking to myself. Okay, so then we can also, another way to do this would be to put actual in one row, budgeted in the next, and forecasted in a third. And this is just multiplying things by the different switches. And there are total revenue forecasts, which are the price times the number of passengers, and then we have to refund some fees, and then we have some other revenues. Okay, I hope this is all right with you. I'm just trying to explain how to use all those switches, and those are the key to being able, all this gets to presenting the history and the forecast together so you can see what's going on. And really, what you can do is when you want to make a forecast, you want to show here's the forecast and then the actual. In this case, they have dotted lines after this. They might have done this by hand. This time we want to make maybe things in different color, and we want to make a nice little graph. That's really what we want to do. And then it's the same kind of thing with the plant balance. Now, when you have a net plant balance, let's go down and go to our plant balance over here. It says if it's the balance sheet switch. So that's how we can use the switches, and we can use the switches if the balance sheet stops in a different form, I can't get words out, in a different period than the income statement or the profit and loss statement. And then we can get our actual depreciation and our forecast depreciation. We can do all of this. Now, next thing is you might, okay, average if it's we want the average of the, just a minute. I put true instead of one. Okay, excuse me. I guess the average if doesn't quite work with a true or a one. Excuse me for that. Okay, well, that's all right. So we get the average for the forecast, the last period, which you use a lookup. You're looking up in this column for this date, and then you're looking in the same column that's not causing a circular reference. And then you can kind of pick one to get your forecast for the actual and budgeted revenues. Now this file is going to be put on the website, and I'll put it in the airport, so you can go along. And I think that other file was not actually confidential. It didn't say it was confidential. All right, so I'll put kind of the bad example and hopefully the better example here. Okay, and then we go through our debt schedule. Now this is just like this for me resembles a lot more a corporate model, because you start with history, you work through all the items. For some of the items, you look and see what happened, what did you have, averages for the history and the recent forecast. So you're using all the historic data for the okay. Once we get to the debt balance, well, maybe it's more, this is just a complicated debt balance, but we have some, in this case, there was some refinancing. So we put a date of the refinancing, and we put assumption in for what the interest rate will be on the refinancing. And of course, you can put a little thing here. And then what we'll do also in a minute is going to see what happens if I'm going to press Shift F11 now to get a new sheet. If we make a summary page and we do things like changing the interest rate. So this is the senior tranche. Okay, and we'll take it from the scenario page, and we'll put our little thing here. Okay. And we can, I think, you can see what happens if we charge a higher interest rate. Will you not pay your employees? I'm kind of joking, but this business of a cash flow waterfall written on paper, and really what will be done, and really what will be done is you better make sure you have enough cash flow to pay off all the operating expenses. So you set up the accounts, you set up all the debt accounts like you would with an opening balance and a closing balance. Sometimes you have some historic, sometimes it's a future, and then this is going to be a really big deal. When you set up a cash flow waterfall, this is not foolish consistency, I don't think, but generally you'll have some items where the cash flow comes from. In this case, I hope this is the subordinated debt. This is the refinanced tranche B sub debt. I had to think about my spelling of that, and I had to stop speaking. Okay, and then we're going to refinance the debt. You can look at all of these, and when you do this in a corporate model, I put all the different debt facilities. We had an original debt facility before the refinance. We had original sub debt. We refinanced the original debt. We refinanced the sub debt, and then you compare that to the actual interest that was on the profit and loss statement, and then sometimes you got differences, and these differences kind of bothered me. They're bigger than you might have thought they would be. Okay, and then you've got some debt service reserve accounts. In this case, the debt service reserve account was nice and simply, it was funded, but we might, in our waterfall, we might have to top it up, and we might have to use it for some deficit cash flow. And in fact, that's what they did in this case. And then we have to use it, top it up, use it, and top it up. And I didn't see any of that in that other model. And then finally, we have a cash balance to see what's left over. So this isn't quite like a project finance model, but where you might have some cash on the balance sheet, and you have some minimum operating cash that you have to deal with. And then, importantly, there are a whole lot of defaults. Okay, and I guess I'll leave that. I'm kind of bothered by that conditional formatting a little bit, but I'll leave it for now. Let me just see what happens if I multiply that by. Excuse me. Okay, oh, that was kind of nice. That's because that's not as nice as you thought. But then if we are going to pay our debt before we pay our operating cost, we could default on our operating cost. If we're going to pay our debt before our capital expenditures, we could default on the capex. So we try to expend it, and we say, no, sorry, you got to defer it. You can call this a deferred one. And then eventually we can say, okay, you can spend your capex later to make your new terminal buildings or your new. Oh, I don't know if I'd want to delay the runway capex too much, but whatever. You've got to, if you're going to have the debt be paid before all of this, you better include that. And then we just make a forecasted profit and loss, and we make a forecast. I'm a little embarrassed about all these checks, but we make a forecast, and then the forecasted profit and loss is just normally, but this time we have both history and forecast, and that's what we really want to do. And we show what the passenger numbers are and everything else. And now what we'll do in just 1 minute is we're going to take this and we're going to make this whole thing into an annual model. But before I do that, I want to go through the real cash flow waterfall. So you might say, okay, let's start with how much cash we have on hand at the beginning of the period. Now this kind of was funny. They had some negative cash because of they were dipping into the debt service reserve and all that. And then we say, okay, let's start with this cash, and then let's see how many revenues we get just from our passenger numbers. And then we can say, well, we should adjust this for our change in accounts receivable, because this should be actual cash revenues, not booked revenues, not billed revenues. So this kind of goes up and down with the seasonality. Okay, and you could also say, all right, well, I don't really care about that. I'm going to, uh, uh, I'm going to turn it off. So I made a little bit of a true false that says ignore changes in working capital. So if we put this as to true, we can say, let's not worry too much about those accounts receivable and accounts payable and all that stuff. And let's just, when we get a true and false variable, and let's put let's put this in another sheet, back to this sheet. Maybe you're not liking my conditional formatting enough. I'm going to probably have to work on that one a little bit. But okay, if we put that as true, and then we can also copy this to our summary page. Okay. And we'll say, I'm going to kind of make it a little more polite this time and say no working capital. Okay, and then changes. Maybe that's not really great, and then I'll put that here. So that's how we can start using all our little factors. Now, when we do this, the big other thing I think to do would be to say, look, if we're bankers, let's be real. One scenario is to use our term sheet and say tranche A is senior to all the debt. Okay, but let's make it more complicated and more interesting. It might be that tranche A is senior to all capex and opex. It might be more realistic to say, well, it's senior to opex, but you got to pay the capex. You can defer the capex. In other words, this one you can default on the capex and the opex. This one you can't default on the opex, but you can default on the capex. And I should change those names, I think, and I think I will. Senior to OPEX and CAPEX. No, that's okay. It allows a default. This allows a default on CAPEX, and this says, no, you're going to pay your OPEX and CAPEX first. So we're going to make 3 different scenarios with the cash flow waterfall. Okay, and we're going to think about which one is realistic and which one should we really use to evaluate whether we actually have a default in our model. Okay, and we'll leave this in the scenario page. Now, obviously, what I'm doing is I'm kind of finishing this model as we're going through this. Now, the big thing here is you can say, okay, let's put all of the we'll put all the revenues we get, and this is the amount cash from all the revenues. Okay, and that's consistent with our little budget, our little collection account thing here. Okay, all right, we can start with that, but then we say, okay, then we can say, okay, let's add the other revenues, and let's add subtract the operating expenses, because I'm going to say there's no way you're going to pay all the employees and not pay and have the employees not get paid because you pay off the debt. That's my opinion. And then we can adjust for the liabilities as well. Okay, current liabilities. Now no change in working capital. Excuse me, our employees first. Okay, we have a negative cash flow. We don't have any negative cash flows in the future. Actually, I'm going to let's make a little bit of a worse kind of scenario analysis. So here we have some, I'm going to first Control Alt C this one, Control Alt C it. That's not really a verb, but whatever. Okay, so you can kind of see the various inputs. And I put some inputs here for operating expense growth and some inputs for some uh, stress case revenue, where the revenues here go down, okay? If F11, but we'll eventually, of course, show this we'll show the history together with the forecast, and we'll show which one we took, which scenario we used, and we'll make this on an annual basis, and then we'll be able to evaluate what happened to our defaults. Okay, so what I'm going to do right now is to add. Now, what I did here is I said, okay, for the passenger growth scenario, this could be 2 or 3 or 4, but if this depends on our kind of overall scenario master, so we put the different code numbers for growth in passengers, other rental income, fuel income, and everything else. So we've got a sensitivity for operating, we've got a sensitivity for forecast. We probably should put a CapEx sensitivity in. Come on. Because we might have to spend more money on that. CapEx, that's just an overrun scenario. So if we put this in, let's just make the first one 100%, and then we can, oops, I didn't mean to do that. We can copy this down, Control D, we can press Control R here, Shift Control P, and then we can make a lowercase 110%, and then we can make our stress case. We can make this, how about 125%? Okay, so it's going to cost us a lot more. So if we change our overall scenario to our stress case, which is number 4, and by the way, oh no, shit, I forgot to do this, and I'm sure I'm going to have to press Shift Control R and Shift Control R again, and excuse me for all of this. Okay, let me pause the video. I suppose I'll make a gimmick here too. If you select this and then go to conditional formatting and go to new rule and use a formula, which you all should do by, if you watched a couple of my videos, and you press that one and make it equal to, you go all the way to the left and press the F4 key and just keep that off. So we're just going to keep it on the C, and then you go to format, and then you can show what kind of what scenario. Picking the color is a big deal. Okay, oh, that's a bad one. Let's try this one. Okay, and then hopefully it'll show us. So if we're on scenario 4, it shows us that's conditional formatting, and then you can make your little scenario button, okay, or whatever you want to call this. Now, I say this scenario page can be a complete mess, a total mess, okay, and the cash flow waterfall, that should be very defined very well. Now, the whole reason I'm doing this right now, and now let's put the cell link onto the other one. I'm trying to multitask, and I'm very old, so it's not easy for me, and I'm male too. If I'm trying to make the stress case, so see what kind of structure do we have in the stress case? What happens to our scenarios in the stress case? Okay, in other words, what happens to the default? I'm finally going to get the right answer out here, and maybe we should also copy this to our other model so we can see what's going on. Okay, so in the stress case now, that was not, I've not been drinking, I promise. Okay, in the stress case now, oh shoot, I wanted some negative, uh, negative numbers, just a minute. Okay, so I made a little bit of a more extreme case, and what I really wanted to show you is that when you make one of these uh, cash flow waterfalls, okay, so the first case, I'm going to pretend we actually pay all of our operating costs and pay our capex. So that's our first waterfall assumption. Then we see how much is left over, including the cash we have. Okay, we had no kind of other interest, and I hate this false thing. Okay, and then we hadn't defaulted yet, and then we go through and we see if we have a negative cash flow. When we have a negative cash flow, then we have to use the debt service reserve account. And we use a maximum, if this is less than 0, it's a maximum of the minus number. And then we also see if we can only use it if we have cash in our debt service reserve account. So we go up to the debt service reserve account and compare that using the opening balance. That's what the minimum function that does. It's a max min, and then if we have positive cash flow in the next thing, we use that positive cash flow to pay it off. And then if you still have some cash flow after that, then you can start going down and paying your senior cash flow. I mean, your subordinated debt. And then we go here, and I had some more negative cash flow. And I hope here, this one, I want to get to a situation where we had some negative cash flow, and then we have nothing left in the account. So that now we actually have a default on our debt, and that's what we're really evaluating. And then I put such negative assumptions in here that we'll have more and more default. Now, so that's all done with a max min. Look, this is another max for the default and a max min. And what you need to do is then set up all of these little default balances. We have a default, possible default on our senior debt. We also have a default on our operating cost, and we have a default on our capital expenditure. And the kind of the big deal about this is that if you, let's change this around. So this is my realistic case, but if we really read the debt agreement, it says you're supposed to pay off this debt before you pay any of your employees. So then you can see, okay, here's how much cash we have left, and then this is how much cash flow now we have left to pay our operating costs. And if this cash flow is negative, we do the same sort of thing. We have a default. We don't have enough cash to pay our employees. And then you can repay the default, and you repay the default. If this is a positive number, you repay it when it's a minimum. So what we've been able to do is do different kind of cash flow waterfall scenarios. In this case, I said, well, let's ignore the capital expenditures, but let's make sure you pay your operating costs, because that seems to be realistic. And then we'll be able to put a little waterfall graph in our summary page. And then you keep going down after you've gone through the operating cost. I called it a delay or a deferral of capital expenditures. And finally, you get to the subordinated debt. And if the subordinated debt, if you have some positive cash flow, then you're going to sweep the subordinated debt and start paying that off. If there's no cash flow, you can't pay anything off. And then when you look at the subordinated debt, in this case, they had a payment in kind interest. So when you set up all of the accounts up here, you put the, I hope I have tranche B somewhere here. Tranche B, subordinated debt. This cash sweep comes from downstairs. If you go downstairs a little bit here, this debt service reserve account that get funded for the deferral and the amount that gets topped up, that came from the cash flow statement. That came from the waterfall. The default on the debt and the repayment of the default on the debt came from the cash flow statement. It's all about doing your maximum and minimum function and statements in the cash flow. Now, I think this was a pain to really go through and observe, and I think it would have been much better. And that's the final thing we're going to do. Is I'm going to make a new sheet. It's really what that other crapo model had, and what we're going to do is put a annual analysis. Okay. Oops. All right, and then we'll just be about finished. Come on. What? What's the matter? I'm making a video. Okay, and then so here's how we do this. I'm going to take the titles and I'm not gonna put all of the stuff in. I'll just start with the profit and loss, and we'll take all of the titles we did all the way through the balance sheet. Now I should talk to you just about the balance sheet for a minute, because you know that there's no more ecstasy in life than when the balance sheet balances. And that's really, really true when you have a complicated cash flow waterfall just like this. There's nothing better and there's nothing worse than when it doesn't balance. And I think I really should make some t-shirts about that one. Okay, maybe that's how I can make money off of this stupid little website thing, is to make balance sheet balance t-shirts. Okay, and then let's put the year here. So let's start with the very first year we have. And now we're going to be able to we're going to be able to put the balance sheet together with the forecast and just add one here maybe. And I don't know how that was probably way too much, but no, maybe not so much. Okay. Well, I'll leave it for now, and then we can change it. Now, when you do all of this, you just have to use one single statement, sum if. And when you do this, please, 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 I just can't believe why people don't do this. Maybe I'm missing something about this, but you use the whole row or column. Now, maybe maybe there's something that slows you down or something, and I'm going to test this out, but not while I'm doing it now. So is that the one that's the one I said, I can't press Shift Control D, Shift Control R, and then I hope that I have the formulas off. Okay. Well, this looks bad. Okay. And then I'm copying it all the way, way down to the bottom. Okay. Now, when we have balance items, we're going to have to do something a little bit differently. And I'm going to use this opportunity to remind you kind of how to do this. Okay. And I see the mistake I made, which was really stupid. And understood that. It was really bothering me. And why don't I make it all the way down? Shift, why don't I just press Control D and then Shift Control R, and then if I was not making the video, I would press Shift Control D, but I can't do that because of some shortcut key that's taken on this, and it's taken a little bit long, so I don't know what to say. All right, after a little bit of a pause, let's continue. It's actually a little bit more than a pause. Everything takes me longer than I thought it would. So on an annual basis, here's the good news. We have the cash flow waterfall with the alternative possibilities where we can either have our waterfall first pay the revenues and the expenses here or otherwise, and then default, or we don't pay these revenues and expenses and have less of a default on the senior, and then we use the DSRA if we have to, and then we have later a default on our senior, and potentially more of a default on our operating costs if we pay the senior first. So that was the whole idea of this slightly more complicated cash flow waterfall, and then we have a cash flow sweep. I can't get the words out on the next one. So after that, we could try to make a graph, some graphs. We could try to make a graph of all the positive. Let's take all the positive cash we're getting and then show where that goes. Some of it goes to operating cost, capex, interest, repayment of deferred operating expense, deferred capex, and at the very end we might have a little bit of surplus cash. That's a graph of a waterfall. So I'm going to show you a couple of the other ones, and then I don't know, I was hoping this would be a really cool graph, and then we can say, okay, here's our payment of our tranche B or sub debt. Maybe that we should have had a sweep on the senior debt, and if we have a little bit of a low case, it takes a little while longer to pay our debt. We seem to have some cash. If we have a really bad debt case, I can't even find it here. A stress case, we have nothing. Okay, and that we see a little bit of the pattern of the cash flow. The positive cash flow was the blue line, by the way. Then it might be more interesting to make just a graph only of the defaults. And when we make a graph of the defaults, oops, I haven't put our little stress case thing in. Actually, here's what I'm going to do with this one. In the summary case, we could put this default graph, and then we can put a graph of some forecast assumptions, and finally a graph of how much debt balance we have. And the other thing we can do when we're finally finished is decide which one of these subordinated senior DSCR, synthetic DSCR, LLCR, debt service coverage ratio, debt to EBITDA, which one of these is really the best one to apply in our situation. And we should really think, what does this one really mean? In this case, the debt's going down, very good. The EBITDA, in this base case, it's all staying positive. Now, and then we can look at just our collections coverage ratio, which is just the revenues for collection. This is a meaningless one for me, but it was in the, it doesn't have any operating costs taken. It's revenues that are for the direct payment of the debt service relative to the debt service. And then we can have just a senior DSCR, which looks kind of low, but remember, this is a very short-term facility on a long-term asset, so it's a little bit distorted. So we could use these Fitch ones to look at a longer-term DSCR, and then we can look at the loan life coverage and the And when we look at all of these, we can look at the senior. Now, we should never compute a subordinated loan life coverage. You should look at the total debt, not just the sub-debt. I always use a little example to illustrate that. And finally, the interest coverage. Maybe that's the best thing to do, because maybe we can finance all our repayments, refinance all our repayments, but we better make sure all the uh, all of the EBITDA covers the interest. Now, of course, if in corporate finance, you can try to find some of these little uh, uh, um, tables that compare the ratios amongst different companies. Now, when you do this, you've got to be very, very careful. Okay, if you're trying to simulate some kind of there's some of the ratios. You can see these ratios look a lot more like corporate finance than project finance. But when you do that, I've got a whole kind of little section on this. You better really adjust these ratios. You can't just say, here's the ratio for AAA or double B or triple B. You can't do that. You have to adjust for the business risk. So here's some examples. I think I've got some here. Here we have, this is just focusing on this is like CFADS almost, cash flow available for debt service minus interest, actually, divided by debt. And then it depends whether the business has below average or above average business risk. So the same number here, it gives you a triple B, and in this case, it gave you somewhere between a triple A and a double A. In this case, a 45 if you're below business risk average, that gave you a triple B. But if that same ratio up here would give you somewhere between A and a double A. So it's to just say, oh, I can look at these ratios like Damara did something like that. What a crime. What a goddamn crime. Okay, enough of that. All right, so now let's look at our default case. So in the best case, in the base case, we had no default, but in the low case, not so much of a default. We could push our passenger traffic down, and when we push our traffic down, now this blue line just says, okay, we have a default on well, we use the DSRA, and then you replenish it. That's why it's a funny looking thing there. So our traffic could go down by 81%, and we have a little default, but we're able to repay the default. Now, if you instead had the structure where you first pay the O&M expense, you'd have a default on the operating expense, not on the debt. That's the point. And then if you had this one, you'd have just a default here. I'm sorry, this is a second one. We'll have a default on the capital expenditures, and in the final one we pay the capex, and we have a higher default on the debt. So the structure of the waterfall has a big effect on the potential defaults, and then if you keep going down, you can eventually the defaults get much larger, and we can never pay back the debt, but we can see what kind of break-even point we need to get before we get to this horrible level. And then if you, well, maybe that's about the break-even point. And then if you look at this, well, you can look at the forecast compared to the actual. Here's the actual EBITDA, and our forecast has to go way, way down before we get to this kind of disastrous position. This is this peak to trough that I introduced. So once you have this annual model and the different waterfall characteristics, then you can really kind of do a little bit of good analysis to see what your break-even points are. Now, just quiet, just a minute. I'm just finishing. Okay, and then we can also see at what point does the subdebt default. Now, if we go all the way back up here, okay, and I should do this one. Okay, we're defaulting on all the subdebt. Its balance is just going up and up and up. Let's use the base case, and then we've paid it off. So you can see just what happens now if I increase. This is again just the passenger traffic sensitivity. All right, and we're just finally there. So in the base case, we've paid everything off. In the low case, which again, the low case was defined in this scenario analysis. We defined all of these passenger forecast scenarios first that had a time series, and then we put a little code number in, and this code number here comes from our scenario table, and then in our scenario table we use the index function with an overall scenario, so we can either put in a directly lower number or we can put in time series. That's what I meant to say. And in the management case, everything gets paid off fine. In the stress case, we paid nothing, and nothing got paid off. And in the stress case, we can kind of put how much the traffic would have to be more than what we thought to finally get it to pay off, okay? That's an illustration, really, of what you can do on the models, okay? I should put a little reset button here, I think, with a little button, but I'm not going to. All right, and I think that's it. Now I hope you're interested in this model, and this model will be placed up here if we go to project finance, and then, right now, if you go to down here to the airport models, there's basically nothing there at all. Okay, I'm going to put this model with a little bit of explanation step by step on this, particularly some of the cash flow waterfall aspects, and that's enough of this video. Okay, whoops.